Ciao, folks. Welcome back to Money Otter, everyone. I'm Alice, excited to dive into today's market roller coaster.
And I'm Benjamin, ready to break down the latest financial headlines. Today, we've got a surprisingly strong U.S. jobs report, which has sent the indexes jumping up. But there are also potential global headwinds to consider.
It's a real head scratcher for some economists. The September non-farm payrolls boomed to 254,000, beating the forecast of 150,000. This was supported by 69,000 jobs from hospitality, which typically only adds about 14,000 jobs on average.
And we also saw the previous August data revised from 142,000 to 159,000. This is particularly interesting given the Fed's recent rate cut. The August jobs report may have been the reason why the Federal Reserve lowered the federal funds rate by 50 basis points on September 18th instead of 25. Today, we have seen that the August jobs number was revised to 159,000, which is still lower than the initial estimate of 160,000, but not by a significant margin.
This has drawn critics about the accuracy of the data. Is the revision and strong data related to U.S. presidential election? Most importantly, it makes you wonder, what would have happened if the Fed had this revised data at their last meeting? Would they have still cut rates by 50 basis points?
It's impossible to know for sure. The most significant implication for investors like you and me is the shift in market sentiment. The market is now fixated on a soft landing scenario. This implies a healthy economy, controlled inflation, slower interest rate cuts, and positive economic news translating to rising stock prices. This marks a reversal from the good news, bad news situation we saw 3 months ago for the Fed. As strong job growth typically indicates a robust economy, which is the Fed's goal. However, it also raises concerns about inflation. When more people are employed and earning, they tend to spend more, which can increase demand and drive up prices.
Speaking of inflation, economist Mohamed El-Erian warned that it's not dead yet, even with this strong jobs report. Bank of England Governor Andrew Bailey has been sounding the alarm bells about the escalating conflict in the Middle East and the potential for another energy crisis. So, we've got a global landscape clouded by geopolitical uncertainty and a domestic economic picture that's surprisingly strong, but with potential inflationary risks. What's an investor to do?
Don't panic. That's the first rule. Second, stay informed. Keep an eye on upcoming Fed statements, inflation data, and developments in the Middle East. And as always, make sure your portfolio is diversified and aligned with your risk tolerance and long-term investment goals.
Great advice, Benjamin. We'll be keeping a close eye on all of these developments and bringing you the latest analysis and insights here on Money Otter. Make sure you subscribe to our channel and hit the notification bell so you don't miss an update.